All right, let's get started. This is our briefing on the U.S. market peripheral notes for March 6th, 2026. Just a quick note before we dive in. This video presents a direct informational narration of the source document. We will not be providing any additional interpretation. So here's our roadmap for today's report. We're going to kick things off with a macroeconomic data analysis, then pivot to the geopolitics and energy storm. After that, we'll examine U.S.-China relations as a potential buffer, then dig into market structure and volatility. From there, we'll take a deep perspective on some key stocks, and we'll wrap it all up with credit risk and strategy. Today's performance in the U.S. stock market really signals a profound paradigm shift in the market's logic. As we're seeing macroeconomic data weaken and geopolitical premiums getting priced in very aggressively, the whole sentiment has flipped. We've gone from a logic of greed for rate cut dividends to a much more defensive posture against economic stall and liquidity risk. From a strategist's point of view, the volatility we're seeing isn't just simple profit-taking. No, it's a collective risk-aversion behavior by institutions that are staring down multiple uncertainties at once. Okay, let's jump right into our first section, macroeconomic data analysis. We're going to be focusing on the deceleration in the labor market and the dynamics of the consumer structure. The employment and consumption data that came out today have really cast a shadow over the Federal Reserve's policy path. And this isn't just about a data revision. It's a direct challenge to that whole Goldilocks economic outlook. Let's break down the February key labor market indicators. First up, non-farm payrolls. The actual number came in at negative 92,000. That's against a market expectation of a positive 55,000 and a prior reading of positive 126,500. The core analysis here? This is the first negative growth we've seen in 20 months and strikes in the healthcare industry were the main drag. Now, looking at the unemployment rate, the actual rate was 4.4%. The market was expecting 4.3%, and the prior value was also 4.3%. The analysis indicates it rose more than expected, and this reflects a couple of things: AI substitution effects and geopolitical uncertainty, which are both suppressing the intent to hire. All right, shifting gears to consumption. January retail sales fell by 0.2% month over month. That's the first drop we've seen since last October. Now, the direct causes were pretty clear: weak auto sales and some really extreme winter weather. But, and this is an important offset, economists are expecting a larger scale of tax refunds in the first half of this year, and that should provide some potential support for consumer spending. So what this suggests is that the current weakness might be more of a seasonal fluctuation than a real long-term trend collapse. So what does this all mean for policy expectations? Well, right after the data was released, the probability of a June rate cut jumped from 30% all the way to nearly 38%. Goldman Sachs is sticking to its forecast of 2 rate cuts this year, but you can see the Fed has much less room for error now. The market is in a really fragile state. The initial reaction tells us everything. Traders are prioritizing growth concerns over any potential rate cut benefits. And if the next 2 employment reports don't show some real improvement, you can bet the market is going to start pricing in a recessionary logic much more quickly. All right, moving on to Section 2, geopolitics and the energy storm. Here, we're talking about the stagflationary threat of crude oil prices. What we're seeing is that geopolitical conflicts are translating into market risk at a rapid pace, and the main vehicle for this is the price of crude. As those energy costs soar, those old fears about both inflation and stagnant economic growth are coming right back to the forefront. And we've had a pretty critical point here. WTI crude oil price has broken $90 per barrel for the first time in nearly 2 years. And that has triggered some absolutely historic volatility. This week's cumulative gain reached 35%. To put that in perspective, that is the largest single-week increase since futures trading records even began way back in 1983. Okay, so let's unpack the current game theory. Trump's stance is extremely hawkish. He's signaling a protracted war unless Iran offers unconditional surrender. This is being compounded by the White House projecting a 4 to 6 week timeline for military action and a warning from Qatar's energy minister that oil prices could easily blow past $100. As you can imagine, all of this has severely compressed the market's risk appetite. Now, a key point on these geopolitical premiums: investors need to be really cautious about media rumors you might hear about China or Russia aiding Iran. With Trump's planned visit to China in April, these stories are very likely smoke bombs. They're intended to create negotiation leverage. So it's absolutely crucial to focus on substantive diplomatic signals, not the media noise. Next up, Section 3, where we'll look at US-China relations, specifically how large commercial orders, like those from Boeing, can sometimes act as a geopolitical shock absorber in a really tense environment. So, what are the potential details here? Well, China is reportedly considering a massive agreement with Boeing. We're talking a deal that could include approximately 500 units of the 737 MAX and potentially another 100 units of the 787 Dreamliner and 777X. This model really emulates the Airbus diplomacy that we've seen when European leaders visit. But there's a huge challenge here. Boeing's own production bottlenecks and their ongoing quality scandals are a core variable. So, as a result, the market's reaction to this kind of order diplomacy is, quite frankly, understandably cautious.
Okay, Section 4. This is a really interesting one. Market structure and volatility, or what we're calling revealing the institution's true hand. Because while the S&P 500's decline seems pretty limited on the surface, the volatility market, specifically the VIX index, is sounding a much more urgent alarm.
So, on key support levels, the S&P 500 is actually showing some resilience at 6,700 points, and it'll likely test that 6,800 resistance level early next week. But here's where things get strange. The anomaly signal from the VIX. It closed near 29 today. Now, to put that in perspective, go back to last November, when the index was at 6,500. The VIX was only between 25 and 28. So a higher index today with a higher VIX level, that tells us that the market's underlying panic is actually much deeper right now.
And this leads us to the highly hedged paradox. A high VIX combined with a low index decline reveals what the big institutions are doing. They are not panic selling. Instead, they've engaged in highly tactical hedging by buying up put options. Think of it this way. The market has basically bought full insurance for extreme risk. Now, what this means is that if the situation stays calm over the weekend, a large-scale unwinding of these hedges is going to trigger a technical rebound on Monday.
All right, let's dive into some individual names in Section 5, Key Stocks, a Deep Perspective. Our subtitle here is The Exclusive Game in AI Compute. First up, Marvell, ticker MRVL. Wow, the stock gapped up and soared over 18% today. Its really strong earnings and guidance have acted as a kind of stabilizing force for the entire AI sector. Let's get into the nitty-gritty of Marvell's performance. For its Q4 results, revenue was $2.22 billion, just a bit above the expected $2.21 billion. Adjusted EPS was 80 cents, beating the expected 79 cents. And GAAP net profit surged 72%, with total profit hitting $396.1 million. That's an increase of nearly 98%. But the real key is the forward guidance. The company expects its Q1 fiscal year 2027 revenue midpoint to be $2.4 billion, which far exceeds the market expectation of $2.27 billion. Now, for the technical levels, GAAP support is at $95, with a stop loss set at $84.50. Now, let's talk about Oracle and this whole situation with OpenAI's Stargate project. It's really a story of a strategic squeeze. First, OpenAI canceled its Stargate data center expansion in Texas. The core detail here is that NVIDIA established an exclusive position in the project, and they did this through a $150 million deposit and some savvy strategic coordination. The result? They effectively achieved what's being called a tactical exclusion of their rival, AMD. It's a move built on capital advantage, and it further solidifies NVIDIA's competitive moat. And that brings us to our final section, number 6, credit risk and strategy, with a focus on the shadow of dwindling liquidity. The risk in that shadow corner of private credit is becoming more and more apparent, and this is often a precursor to a much wider liquidity crisis.
A perfect case in point is Bout Capital. Their stock has been falling continuously. The risk is stemming from a £36 million, that's about $48 million, loan to a London property lender that actually entered bankruptcy proceedings 3 months ago. And it's not an isolated incident. We're also seeing a chain reaction, with giants like BlackRock starting to limit redemptions on some of their private credit funds. This creates a dangerous negative feedback loop. You see, limiting redemptions is a signal the market fears most because it can trigger retail panic, lead to forced selling of credit-sensitive assets, and ultimately spill right over into the secondary market.
So, let's wrap this up with a summary of operational strategy under all this multi-dimensional pressure. The current market is really at a three-way confluence of macro, geopolitical, and credit risk. But if you have to boil it all down to one thing, the single greatest variable is crude oil prices. It's simple. If oil prices fall next week, a technical rebound will unfold quickly. If they start rushing towards $100, the market will enter extreme volatility mode. So what's the takeaway here? What are the core strategy recommendations? First, position management is far superior to trying to predict direction. For a technical reversal signal, history shows that when the VIX surges up to 35, it often signals a short-term emotional washout and a market reversal. Amid all the various rumors and disturbances we expect over the weekend, investors should just maintain professional calm. You want to look for the opportunities that will be created when those institutional hedges are unwound during moments of extreme panic.